Hello and welcome back to Volatility 411 for Monday, February 7th. I'm Kevin Davitt and I'm part of SIBO's Options Institute. Last week, U.S. equity markets continued to swing with considerable velocity. 10-day and 30-day realized volatility for the S&P 500 index are just below one-year highs. Now, despite the swings, implied vols declined last week as the two volatility measures arguably recoupled. So to explain, 30-day S&P 500 historical vols climbed to 18.3%, and 30-day implieds for the SPX options fell to 19.5%. Now that's a much more typical situation where implieds command a slight premium to trailing realized vols. Interest rates command much of the narrative as yields move back toward 2019 levels in the US and elsewhere. The Bank of England hiked rates last week, and there's now speculation that the ECB will move on rates this year as well. Looking ahead a few days, the at-the-money SPX Straddle that expires Friday afternoon was pricing an up-down range of 2.2%. Now that's quite a bit tighter than the expected range the previous week, but still richer than a more normal vol environment. Last week, the S&P 500 moved in a 4.1% high-to-low range. Now, this week, earnings will continue but slow relative to the recent pace because about 2/3 of the S&P 500 components have reported. And Thursday, we'll get the latest look at CPI data, which has become the big buzzy data point against an inflationary backdrop. So, VIX index remains well above 20. Earnings will continue as realized and implied volatility measures for the S&P 500 reconcile. That's Volatility 411 for Monday. Thanks very much for tuning in.